Hello, welcome to the October 2020 installment of the Business of Alt Protein seminar, part of a commercial seminar series put on by the Good Food Institute as part of our GF Ideas community of over 2,000 entrepreneurs, scientists, investors, students, subject matter experts, and others who are active in the alternative protein innovation ecosystem. And this is one of several webinars that we do monthly. And the focus of the Business of Alt Protein is to dive deep on topics relevant to starting and scaling an alternative protein business with an expert who can share insights that are helpful and put a lens towards this specific niche but growing industry. And so that's why we've been excited to kind of have this topic of scaling over the last couple of months. We had Jordan Canis, a director from Silicon Valley Bank, present on unlocking debt financing. Last month, we had the former chief engineering officer of Impossible Foods, Mark Warner, present on scaling up industrial bioprocesses like cultivated meat or fermentation. And then we kind of continue that trend with Jordan Stowe from CSC Leasing, talking about equipment finance, which is an important part of scaling up your production capacity or even your R&D capacity. So before we dive into that and I introduce Jordan, I do have a few housekeeping items here. The first being I will be taking notes and you can find all of the past notes as well as past recordings in this agenda document, which I will paste in the chat. And you can also sign up for next month's presentation at the link that I will post in the chat. And that will be Jennifer Stokovic from Vegan Women's Summit presenting on gender bias in the alt protein industry on November 13. I think that is all I have, other than you will receive an email recording and the deck after the presentation, and we will have a Q&A period at the end of the presentation. So please use the Q&A box through the Zoom functionality. It should be at the ribbon at the bottom. It says Q&A, and I will ask those questions at the end. That should be good to go. Jordan will let me know when he's ready to move on to the next slide. And yeah, we will go ahead and get started with the content here. I'd like to introduce Jordan Stowe, who's a regional director from CSC Leasing, which is a firm that specializes in equipment finance solutions. Jordan has been very active in this kind of emerging alt protein space as it applies to equipment finance, and excited to hear some of his insights on kind of how that system works and some advice on how you can utilize it. So without further ado, Jordan, take it away.
Great. No, thank you, Nate. And glad to be here with everybody today and excited to partner with GFI to bring you this virtual content. I think it's going to be really helpful to a lot of folks. As Nate mentioned, I'm Jordan Stowe, a regional director for CSC Leasing out of our Atlanta office. And I'll be talking about a lesser known form of early stage debt financing, which is non-dilutive equipment leasing and technology leasing as well. So yeah, the goal here is going to be to educate the group on how equipment leasing works. I'll define it for you, talk a little bit about the value of equipment leasing as an alternative or complementary funding source, and then discuss kind of why it's often a smart financial decision for companies at really every stage, but more pertinent to this conversation, especially startups. So, quick qualification, why CSC, why are we qualified to talk on this subject? We are a 35-year-old family operated equipment leasing company based in Richmond, Virginia. During that time and since the mid 80s, we've been solely focused on equipment financing. So, we financed a little over $1 billion in transactions across a variety of industries, including in the food tech, alt protein, cultivated meat space, and companies really across all stages of life as well. So, venture-backed, early stage, emerging growth. We have hundreds of R&D stage companies in our portfolio. Private equity-backed, middle market companies as well. And then, your more established, large corporate, large enterprise, with historically some vendor programs sprinkled in there as well. So, we thought it'd be beneficial to share kind of what we learned and some of the insights we've gained, from working in the industry for the last 35 years. And we can go to the next slide here. So I wanted to talk about, what we're going to discuss today real quick. I thought it'd be good to kind of jump off and discuss some of the funding challenges, not new to anyone here, but, COVID in 2020 has been one for the record books. And with that, it's presented some unique funding challenges, and kind of use that as a diving off point to talking about equipment financing. What is equipment leasing? Some benefits, how it works. And we'll look at some case studies for, some food tech, biotech oriented companies and how they've leveraged equipment financing to execute on their growth initiatives. And then would wrap up with a little bit of equipment leasing overview, more broadly the venture debt market, a little outlook there. And then we have some time for a Q&A. So we can dive in here. Next slide. So funding challenges, I put on this slide, this notion of winners and losers. And really all I'm saying here is 2020 and the pandemic has really kind of highlighted this notion, which is companies that were successful raising money, raising capital pre-pandemic are continuing to find success. And companies that have had struggles, this has really only exacerbated those issues for them. But, regardless of the pandemic, early stage growth oriented businesses, they're always on the fundraising trail, especially startups, and it can feel like a never ending process. So, you factor in today the economic disruption, COVID, et cetera, you're seeing equity providers hold on to funding more. And at the same time, you have debt providers that are looking to de-risk their portfolio. So, that's an interesting kind of, collection of challenges that kind of arise and are in this area as a company grows. A caveat here, not new to most of you, but relative to the industry, there's increasing levels of investor and consumer support here and interest in the space, whether it's supply chain, food security, sustainability, even health issues that have arose, in the industrial animal agricultural space. They've all been on prominent display as a result of the pandemic. So it's no surprise, the bioengineered food space, it's one of the fastest growing areas for VC investment. More equity has flowed into the space in the first couple of quarters this year than has in all of 2019. And these tailwinds are gonna remain for the foreseeable future. But there still are challenges, not new to all of you, but worth kind of mentioning. Limited cash runway. I'll talk about this idea of cash is king, but really at the end of the day, a lot of lenders are becoming more stringent on liquidity requirements when it comes to evaluating companies and lending to companies. I'll hit on that a little bit later on in the conversation. But it's also hard to find lenders and investors when you're pre-revenue. And it's a long, laborious process to receive money. And at the end of the day, more often than not, you're giving up, precious equity to do so, through covenants and warrants and the like. And, when it comes to depreciating assets, kind of the purpose of our conversation here, we believe that there is a better use for equity dollars for your business, whether it's, key hiring, talent acquisition, IP protection, general working capital. So, when it comes to purchasing or acquiring equipment and other depreciating assets for the business, if you can use non-dilutive equipment financing options and preserve that equity, that's big and that's near and dear to our hearts at CSC. So we can go into the next slide and kind of wanted just to jump in here and define equipment leasing for you. In essence, it's a rental agreement where, the owner of the equipment, the lessor, CSC in this hypothetical example, allows a user to operate and make use of the equipment for an extended, term of the lease. And, they make periodic or monthly lease payments to do so. So, you'll see the lessor owns the equipment, the lessee or the company in this case would be the user of the equipment. And there are, a lot of different types of leases, relevant to this conversation. I put 3 of the most common types. You have a true lease, which can also be called an operating lease or a fair market value lease, which we'll go into more detail on. There's a capital or finance lease, also known as a dollar buyout, and then a lesser known structure in leasing, a sale leaseback as well. So we'll dive into all those and go to the next slide here. And really what I wanted to do is just define equipment leasing more broadly for you. At the end of the day, it's a financing alternative for purchasing technology assets or other equipment from a vendor. So instead of purchasing the equipment up front and paying a lump sum for that, the assets can be financed over an extended term at a manageable payment per month. This is conducive to underlying cash flow. It's key for equity preservation. So that's really what it is in a nutshell. It's fairly cut and dry and fairly straightforward. Who it's for, to answer that, it's a broad range of users. Startups. Every company from startups to Fortune 500s are utilizing equipment leasing as a capital strategy for their business in some way, shape, or form. It's a solution for companies that want to preserve cash. They want to preserve their capital instead of spending it on depreciating assets, as I mentioned before. So again, back to that notion, cash is king. So, startups, to the extent that they know that this is available and that they're eligible for this type of lending, can find this especially appealing. So, you have leasing companies like CSC that specialize in early stage financing. And what you find is we can say yes, and these companies can say yes more often. And that's because instead of relying on traditional revenue and cash flows and receivables to base the financing decisions on, a company like CSC has the experience to kind of understand that long-term underlying intrinsic value of the equipment at hand. And we can leverage that and use that as security for providing a debt finance option, as opposed to relying on things like warrant coverage or personal guarantees, negative pledges on IP, even covenants. So it gives early stage companies, R&D stage companies, access to additional capital where other options may be just unavailable or diluted. So, really, just to reiterate, any company that needs mission critical assets could be a great candidate here. Alternative protein, food tech companies, CSC is a capital resource for businesses that need equipment to outfit R&D and innovation labs, specialized bioprocessing equipment that's needed to support proof of concept work or growth initiatives, and then even food manufacturing production equipment to execute on commercialization plans. So, everything from bioreactors, ancillary fermentation equipment, synthesizers, other lab assets, temperature control. I mean, really, you name it. If it's an off-the-shelf technology or even a more specialized piece of instrumentation, you can most likely finance the upfront cost of those purchases. We can go to the next slide here. So, let's say you anticipate needing some equipment, now or in the near future. Where should you start the process when selecting a potential partner for equipment leasing? And, what are some of the questions you should be asking? So, I put on here direct funding source. There are broker and syndication companies out there. They may appear on the surface to be funding sources, but in reality, what they're doing is they're packaging your information. They're sending it to their network of funding sources, and they'll make origination fees on the transaction, or maybe they're being paid, via retainer. And brokers and syndication companies absolutely have their place and contribute to a healthy financial ecosystem. But just make sure you're aware of the company and the reasons for working with them and kind of what their background is. A great example here, I'll be actively engaged with a company and working through an opportunity. They've engaged with another company that ends up being a broker, and I'll receive that same company, that same opportunity from that broker who's leveraging CSC as a funding source. And we manage that channel conflict. That's all fine and good, but just an example of kind of who you work with and how that can affect kind of the process and some of the execution and the timeline there. Really specific to this audience, I think, industry or asset specific lenders is something that you should really understand, asking who the target clients are. So does the leasing company have specific domain expertise regarding industry, asset class? A lot of leasing companies will focus on very certain, very specific industries or very specific types of equipment. So a great example is a leasing company that only focuses on over-the-road trucks and transportation companies, or you have IT technology lessors that only do those types of assets. So something to understand, really further to that, credit tolerance, risk profile, bank and non-bank lenders, you should understand, what is the target credit profile for that particular company. So, some only work with large investment grade clients. Some are, specialized in more mature businesses that maybe have struggled financially. And so they're more structured credit shops. And so just ask yourself, would that leasing partner have an appetite for, a pre-revenue or an early stage or an R&D stage company? Or are there certain time in business or financial, performance requirements that would preclude them from lending to you in the first place? And lastly, don't be afraid to ask for references, good and bad, and understand a little bit about the company's background and reputation. So, the finance, the debt industry, it's constantly seeing new entrants. We call them tourist lenders, but it is absolutely real. Here today, gone tomorrow. And it's just helpful to consider when you're engaging with a leasing partner, you want to develop that working relationship, you put time into it. Are they going to be able to support you for a meaningful amount of time and regardless of macroeconomic conditions? So, all good things to consider when you are evaluating equipment leasing companies. We can go to the next one there. So let's say you've identified a leasing company or a couple of different companies and you'd like to explore some options. I wanted to quickly run through what you'd expect, how the process works. So all in all, it's a much easier process, less onerous when compared to equity fundraising, when compared to traditional bank debt. Every company is different, but the typical process is, as a first step, they're going to look to gain an understanding of the company, of the equipment needs, and they're going to do that by requesting standard information. You get an NDA in place here. They might ask you for an investment deck, projections, equipment quotes. All of that's kind of collected and they move into a due diligence review. And there may be a couple document requests. There's probably going to be a couple, credit questions back and forth, but really expect this to last no longer than a couple weeks. If you're in a process that's dragging out 2, 3, 4 weeks without any meaningful credit feedback, you might be in a scenario where you're working with a company who's not well equipped to handle the specific credit profile or asset profile, or you may be with a broker who's kind of exhausting their funding sources and is not able to find a good fit, based on his platform. So, I think a good rule of thumb here, within about a week and a half, you should have kind of some meaningful credit feedback, a path forward or a plan forward on what those next steps look like. When it comes to underwriting a deal, CSC looks at every deal differently, but there are kind of two underlying perspectives that we use. And first and foremost is what is the equipment, right? So CSC and other leasing companies, we are collateral-based lenders. So understanding the equipment is core to the process. CSC is asset agnostic. So that means that we'll consider financing all types of equipment, regardless of the vendor, and we'll even consider doing new equipment and used equipment as well. So, we have a pretty robust in-house asset management group, which we find is really key for looking at projects where high tech or specialized equipment is involved. And then, on the other hand, we'll look at the finances of the business so we can, understand the current and future capitalization there. So, how comfortable can we get that you'll be able to pay us through the term of the lease? Things like understanding cash position, what your runway looks like, what you're planning for your next equity raise, and really progress on those plans are really important for us. What levers you have when it comes to managing operating expenses and thus your burn rate, and really just any details that can clue us into your ability to repay and support that monthly payment for the duration of the lease term. And other than that, we're hands off. We can be flexible finance partners. So if you're paying and all is good, don't expect to be committing a lot of time, monthly or quarterly to managing that relationship. They can be as hands off and as in the background as needed. And so, really after that due diligence stage, we go in, we can price a deal. You can go asset by asset. If you only have one piece of equipment you need at the time, what I'll tell you is more common is we'll come in and we'll offer a lease line. So let's say, hey, I have this piece of equipment. It's $500,000 that I need now, but over the next 6 to 12 months, I'm going to need another $1 million or another $2 million worth of equipment of various types of pieces. And so what we'll do is we'll offer a lease line that's essentially a line of credit that you can draw upon during that period of time. And also worth mentioning here at the bottom, you'll see structures and wanted to quickly hit on a sale leaseback. So if you've already purchased equipment, a sale leaseback can be a competitive option that can help you maintain cash flow and extend your runway without going back and seeking dilutive funding. And in that case, what you do in a sale leaseback is we would buy that equipment that you paid for cash back from you, and you can inject that cash back into your business, and that would be leased back to you. So a great way to monetize existing assets that you've already paid for in cash and getting some of that cash back on the balance sheet for other ROI initiatives. You can go to the next slide there. So talked about the sale leaseback structure a bit, wanted to get into some other structures as well. Fair market value, a true operating lease. Lease structures vary across lenders. I can tell you how CSE structures its lease as a frame of reference. But typical lease terms range from 30 to 48 months. Things like term length, debt rate, all of these things are dependent upon, a variety of factors. So company maturity, financial performance, capitalization and liquidity, the quality of the collateral, obviously the equipment is really important and kind of goes into our underlying calculus of kind of, how we can structure a deal and what that ultimate cost of that financing looks like to the customer. In a financing structure that is a fair market value lease, it's a true operating lease. So you have the flexibility to choose from 3 options at the end of the lease term. And I spelled those out for you here in the slide. We'll quickly run through them. But you can return the equipment to the lessor. You can purchase the equipment for its then fair market value, or you can continue leasing and extend the lease for another year or 2. And just something to note on the lease extension, we have quite a bit of clients that do that. When you do extend the lease and you're recasting that financing, you're going to pay a reduced monthly payment. Typically, you're looking at something that's probably around 40 to 50% lower cost than what your monthly payment was on the original lease term. So just something to consider. What is not on this slide here, but I did want to add a quick note on some other structures that you may encounter. A capital or finance lease can also be common. Some people refer to it as a dollar buyout, where at the end of the lease, the ownership of the asset is transferred to the lessee for a nominal purchase price. So in this case, it would be $1. The lease structure may be more prevalent when you're looking at equipment financings that are kind of below that $150,000 threshold. Terms are typically based on the business owner's personal credit. So personal guarantees are involved. To kick that process off, you're probably filling out a business loan or equipment loan application where they're pulling credit. But really, once you start looking at more meaningful exposures with equipment lenders and the deal sizes kind of creep above that $150,000 threshold, you'll find the prevalence of dollar buyouts will often go down. We can go to the next slide there. So, let's say you've engaged with a leasing company, you've gone through the process here, walked you through that, some of the structures, a couple points I wanted to make when evaluating a term sheet or a leasing proposal that you may see. I'm not going to go through all these, but I wanted to kind of hone in on dilutive components there, that second line item. Often with these earlier stage equipment lease facilities, what you're seeing is a repackaged venture debt facility. So it's essentially a venture debt term note. It's being called an equipment line, and there are, inevitably there are dilutive aspects to the facility. So, I mentioned these earlier, but, things like warrants, covenants, guarantees, liens on IP, all of these can find their way into a term sheet that's intended to finance the equipment or to be a CapEx facility. So you just need to understand and ask yourself, is the deal at hand being secured by the equipment as collateral, or is it being secured, more generally with the company's underlying assets? So, definitely ask some questions and understand that as you look through it. Ambiguous omitted information, make sure that you get some transparency on the lease. It's fairly cut and dry. You should be able to understand, and the leasing company should be able to walk you through all of the cost components and factors that go into your lease. And I'll hit on that a little bit more when we talk about a case study toward the end of the presentation. And then another thing that's not on here, I did want to mention, but deal status. So what does the term sheet represent as far as an approval or as far as next steps? So, are you required to sign off on the term sheet prior to final approval and final due diligence, or is this approved? Are you ready? Is it ready for immediate use? So, for the sake of managing your timing expectations or perceived execution risk even, you should ask, is this an actual approval, or is this just the next step in the credit approval process? And, to leave you with something, as deal sizes get larger, I'd say it kind of 7 figures and up, the instances where you're going to get a term sheet before final approval will also go up. But, look for, in deal sizes that are below that $1 million threshold, if you're getting an initial term sheet, more often than not, that should be a fully vetted, a fully approved and facility ready for immediate use there to you and to the company. We can go to the next one there. So we threw up here a handful of benefits of equipment financing. I touched on a few, some are just kind of underlying themes here, but really the main couple, non-dilutive, lower cost form of capital when compared to your equity, and keeping cash on your balance sheet for other activities. So at the end of the day, again, I'll mention this, cash is king, equity, equity preservation, when it comes to acquiring depreciating assets, if you can go a non-dilutive route, it's worth consideration. So, there's a handful on there, but I think those are really kind of the main themes of what we've discussed today. You can go to the next slide there. So as far as solutions offered, they vary lender to lender, leasing company to leasing company. But here are a couple options I threw on here to discuss. Early stage growth capital, you'll see not all firms are going to take this risk. Some leasing companies, as I mentioned before, just don't have the credit appetite to support early stage companies. Sale leaseback, we hit on, some companies will not do that. CSC does a fair amount of sale leaseback work for companies that are looking to return some cash that they may have used to buy depreciating assets back to the balance sheet and to be reimbursed for those purchases. Lease lines from 100,000 to 20 million. The important thing there is to understand that a leasing company should be able to support you meaningfully for a long period of time. I mentioned, there's effort that goes into building a relationship, and hopefully they'll be able to support you not only early on with smaller equipment needs, but also as those deal sizes get larger and looking for larger exposures. So, having a transaction size kind of, spectrum there, full spectrum, allows CSC to really have meaningful long-term relationships and support relationships with our clients. From an international transaction perspective, again, some companies will be able to support placing equipment overseas. CSC focuses on placing equipment internationally for companies that have a legal entity in the United States that can be our lessee, but we do support companies that are placing equipment internationally. And then, the last two go hand in hand: procurement expertise, end-to-end asset management. At the end of the day, going through leasing, it's one of a laundry list of things and priorities you have for the business. And having a leasing company in there that you have a good relationship with and an administrative team there, it can be an extra set of hands and just an extra employee for you and an extra procurement agent for you as you're managing through, progress payments, multiple vendors, kind of long drawn out timelines. And we're used to doing that. It's core to our business, and it becomes a really intangible added benefit when you're working with a leasing company that's able to support on the procurement side. We can go to the next slide here. So wanted to kind of to switch gears a little bit, talk about some case studies. I wanted to highlight this particular case study as an example for our ability to support fermentation equipment. It's specialized, these assets. Not everyone is going to have an appetite for financing these types of pieces of equipment. They are more esoteric, but not only were we able to support in this particular instance, but we also were able to support a very early stage company. So you'll see here, CSC, we provided the facility that not only covered the company's immediate needs, but also provided additional credit that they could come back and use as additional CapEx needs came up. Another aspect of this transaction worth noting is that the company did have a poor prior experience working with a leasing company. They had been burned, back to my previous discussion on transparency and understanding the cost components that go into a lease. it's fairly cut and dry what you should expect. So, that had been left open and it had been left vague, and the leasing company took advantage of that lessee. So, we worked really hard with the client to get them comfortable with the end of lease options. There were some things we were able to put into the agreement and structure of the lease that provided transparency there on the ultimate buyout, which got them comfortable and ultimately engaged with us on this lease facility. So the next case study here, the next slide, is a recent client in the cellular meat space. And we were able to support them really early on, which I thought would be good to highlight. They've raised minimal equity, seed funded company, and we're still in the prototyping phase. And I think this is a great example of a company who wanted to use, they wanted to avoid using, I should say, their precious equity when it comes to, buying or acquiring depreciating assets. So they were able to leverage CSC and use non-dilutive leasing to maximize their current runway. And really what they did is that kind of bridged them, between milestones, between inflection points in the business, so that they could build enterprise value without going through a dilutive funding round and kind of looking ahead to subsequent equity raises once they've fleshed out that prototyping. So again, just kind of another value add on the equipment side of things. We can go to the next one there. So I wanted to kind of wrap up with a general overview of equipment leasing. It's no surprise here, COVID has definitely had an impact. Regardless of that impact, the outlook does remain stable in the equipment leasing space. Most leasing companies that we've talked to have offered some form of payment deferral, extensions, modifications, restructurings of their leases as a result of the pandemic. So, what you see because of that, in an attempt to de-risk their portfolios, a lot of the lenders have tightened their credit. Some players have since, ceased deploying capital altogether, or they've become highly selective and have dramatically limited their exposure. So, general credit requirements, general liquidity assumptions, all of these things have become more stringent. An example, I kind of alluded to this earlier on in the presentation, but before the pandemic, we were doing a lot with companies that were, capitalized with less than 12 months of runway. And that is becoming tougher. It's not to say that we can't get involved in support with companies without, with less than 12 months of cash. But again, it's become a more pressing question that we ask. And typically we like to see 12 months plus of cash. And that's becoming more of a rule in this current environment. All in all, expect the leasing industry to have a really strong fourth quarter. We historically, as a whole, it's a $900 billion industry. We have a very strong end of the year. And so, really net positive tailwinds against any headwinds here from the pandemic or some of the election noise here. And then shifting gears to the more broadly to the venture debt market, main point here is just, over the last decade and really over the last year or two, we've seen an expanded role of venture debt as a complement to equity and as a capital strategy that the finance groups and that management teams for early stage companies are employing to capitalize their businesses, to fund their businesses. So, as equity investors have retrenched a bit, they've shifted their focus to supporting portfolio companies. We've seen debt options, venture debt options playing a more pronounced role, kind of filling in that void, filling in that white space left by that investor pullback. So, on the other hand, you see a shift of deal terms too back in favor of lenders, which can make debt options more attractive. So a great example of that would be a venture debt option, a facility that may be a better option when faced with the prospect of raising a down round, right? So, all in all, venture debt is playing an increasingly important role. It's something worth considering as you look to kind of add layers to your capital stack and you look to deploy different strategies for the ultimate kind of capitalization and liquidity for your business. If I had to pick a word, I'd say resilient to describe both industries. The debt and equity markets are strong, highly liquid. The election noise will be over soon. So, all in all, some pretty nice tailwinds here, and don't expect any kind of market disruption from the industry as a whole. And then on the last slide, just have my contact information. I tried to keep the presentation high level here. I know some of you might want to talk in more detail about specific projects or specific equipment, and I'm happy to do that offline or in the Q&A as well. So I'll turn it back over to Nate, and it sounds like we have a Q&A as well. So thank you very much.
Yep. Yeah. Thank you, Jordan. That was extremely helpful. I'll end your share here so people can see us. Yeah, so everyone feel free to put your questions in the Q&A. We have a couple already, and I have a short list of questions as well. So I will just dive into the ones that are in the Q&A first. The first one is for purchasing biotech equipment. New equipment comes with relatively high installation costs, to get things running properly. For example, the supply of gas and steam for your bioreactor. Is the lease covering equipment, or is there a way to integrate the installation into the cost as well, into the financing?
Yeah, that's a great question. So we can actually finance a portion of this, what we call soft costs. So the installation, all the kind of intangibles there that are in addition to the hard assets from the vendor. We typically cap that as a percentage of the total deal. So look for about 15 to 20% soft cost support. So again, if you're looking at a $100,000 piece of instrumentation and you have $10,000 to $15,000 in kind of unrelated soft costs, or related soft costs, I should say, then that's definitely eligible to be financed in the lease. Further to that, and as it pertains to a fair market value lease and understanding the end of lease purchase options that are available, understand that if you do end up financing some of the soft costs of the lease, that end of lease purchase option is not going to be applied as a percentage of the overall lease deal. It will only be applied as a percentage of the hard assets that you have. So great question. And yes, we will consider funding soft cost.
That's great. The next question is, what are the typical interest rates that you expect with equipment leasing? And I'll just modify that with, what are some things that you can do or that you look for to bring the cost of capital down?
Yeah.
The key
so yeah, great question. So, I mentioned in the very beginning, we have clients that range from early stage pre-revenue all the way to large corporate Fortune 500. So we have the ability to price and shift kind of with the market on interest rates. A lot of it is going to be kind of single high digit into the mid-teens as a typical range, but it really depends on a lot of different things. So, Nate, to your kind of second question, the biggest thing for us is going to be the capitalization and liquidity of the company, and the quality of the collateral, the equipment at hand. And so, looking at those, it really is kind of a collective, we take all of that collectively to look at the overall structure and cost. But I'd say capitalization and the quality of the equipment itself, and to the extent that the company is operating and generating revenue, what the financial performance looks like.
Great. Thank you. So earlier in the presentation, you had mentioned a willingness to invest in new equipment or specialized equipment. Obviously, in like fermentation or even a lot of plant-based processing and certainly cultivated meat, there's going to be kind of new to the world equipment. So could you talk about your thought process when someone proposes that they want this equipment that requires fabrication or maybe hasn't been proved before?
Yeah, absolutely. So, I mentioned CSE has an in-house asset management team, which is really the secret sauce here for us being able to get involved in all sorts of equipment transactions, whether they are, at least partially proprietary or brand new technology that's not really off the shelf. So at the end of the day, we look at equipment as a means to secure the deal. And if the equipment is relatively new and relatively specialized, it does affect the overall collateral rating of that equipment, but it wouldn't preclude us from doing a deal as long as we have other kind of components of that transaction that will work. So, in those instances where the collateral maybe not as strong, we look at capitalization and liquidity of the company, kind of, how much they've raised and what their runway situation looks like, to rely more heavily on the credit scenario as opposed to relying on the collateral.
Okay, thank you. And I guess going to the opposite of that, say we're looking at a used piece of equipment from another industry, say stranded assets from brewing or meat processing or dairy processing that are, you know, like can a company bring some of that in and then retrofit it? And would you cover that, or, you know, would it need to be like off the shelf, ready to be applied?
So we can consider financing used equipment, absolutely. So we would just need to understand, you know, is that an arm's length transaction? Are you buying that from the company that's offloading that equipment, the brewery itself, and just understanding the dynamics of that relationship and that kind of buy-sell relationship. You know, typically when we're doing used equipment or, you know, equipment that's been refurbished or retrofit, it's coming from a third party, some kind of vendor that we pay directly as part of the deal. So absolutely, we can consider that. It just case by case.
Okay. A little more into that topic. So there are examples of companies that have used extruders, which you know, is the primary way that most plant-based structured meats are formed. And they you know, that's kind of a somewhat outdated technology in a lot of ways, and some companies have found aftermarket ways of making those much more efficient. Are there typically covenants in the financing agreement that would prevent that kind of modification of the equipment?
You're saying that we purchase the equipment from a vendor and then the company goes and modifies the equipment?
Yeah, is that okay, or was that something you discuss ahead of time?
Discuss ahead of time. And what we do is we would circle in our asset management group and just understand what that looks like. So again, it's kind of back to flexibility and having in-house asset management. If we can understand what's going on and the kind of use case and reasoning for that, you know, as long as the equipment's not being destroyed or taken to, you know, links where it could not be, you know, liquidated and resold, you know, we definitely would be able to consider something like that.
Okay, great. We have another question in the Q&A, and two more. How do you make lending and liquidity valuations for hypergrowth startups?
So liquidity and capitalization, we really look at the capitalization history and the plan of the company. So, you know, we look at, you know, how much you've raised to date, you know, what that looks like in terms of current cash position and runway. I mentioned earlier, when we're looking at kind of cash position, burn rate, we like to see 12 months of cash. It's kind of a rule. We can get involved with companies that maybe have, you know, 8 or 9 months of cash, but that we have good line of sight to their next equity round. And so we feel really good about our ability to kind of anticipate and underwrite that the success of that next capitalization event. So I think I answered the question there. Really what we're looking at is how much money the company's burning, how much runway they have. You know, typically we're looking for 12 months and beyond.
Great. And then somewhat similarly, and tied back to the first question, someone asked, are offtake agreements considered for securing leases? So maybe talk about some of the industry specific things that might help secure a lease. So yeah, like an agreement from a company to buy the end product or something like that. Does that help you?
Yeah, from a credit perspective, to the extent that there are contracted, you know, offtake agreements, we absolutely factor those in. You know, again, at the end of the day, our primary security in the deal is the equipment itself and that underlying value. But we look at the credit equation and things like offtake agreements and customer contracts, contracted revenue, things that we can kind of rely on and bank on over the next couple of years, and that give us good line of sight. Are absolutely taken into account.
Great. Another question in the Q&A, I'm not sure if I'm understanding it correctly, but it's kind of about the transition from an R&D or pilot scale facility up to a production scale facility. You know, you're talking about these long-term relationships. What does that look like in terms of working with you? Yeah, you can take that as however you'd like.
So I'm assuming that they're asking, they have an R&D, a smaller scale operation. They're looking to scale into a larger, so that the needs, maybe the equipment needs to be traded in and they need to get larger pieces or to outfit additional. You know, again, it's something that we take on a case by case basis. If we're in the middle of a lease with equipment that's in the R&D lab or the R&D facility, and it's not going to be included in the expansion plans, there might be an opportunity to kind of trade that in and net that out of the next lease. But each lease is kind of handled independently. So if you had a lease for assets that are in the R&D plant and it's a 3-year lease, typically that arrangement runs for 3 years. If there is an early buyout or an early termination or an early trade-in, we look at that. But again, it's case by case because we need to understand where the company is and where we are in the term of the lease to do so.
Okay, great. And we actually just got a follow-up question that's kind of to your last point. Maybe you could talk a little bit more about what the trade-in process would look like if someone wanted to upgrade to new technology.
Yeah, so it doesn't
case.
reside with me. We understand that happens a lot. We're working with the innovative emerging growth, kind of cutting edge companies that are taking advantage of new technology all the time. So when that does happen, we engage the company directly with our asset management group who handles that. And they'll basically evaluate the trade-in value at the time, and we'll figure out if there's a replacement piece or additional equipment that they're going to roll into a new lease at that point.
Great. I'm not sure if you're able to talk to this, but at least in the US, do you have any insights on kind of the tax advantages that can be had of using equipment leasing?
So for CSC structure, it's a true operating lease, a fair market value lease. So CSC actually owns the equipment and we depreciate the asset. So from a tax advantage standpoint, I would say, and kind of fall back on, ask your accountant how you're going to account for the lease. And that's really, most leasing companies are going to tell you to do that. We have we know how we treat it on our books. We have ownership of the asset and we are going to depreciate it. But some companies, have different ways of looking at it. So, I don't think there are massive tax advantages, but there may be some. And I think that's a question for their individual CPA to understand.
Okay, great. In terms of practically, like a company approaches you that wants to finance a piece of equipment, do you expect that they have the fabricator or the vendor already picked out, or is that something that your company or companies like yours are able to help with?
So we can help. Typically, we're viewed as the bank in this scenario. So typically when a company approaches and engages with CSC, they've already identified what specific technology and they've spec'd out that equipment and they have a vendor or a couple of different vendors in mind. We're happy to kind of help them go through that process if need be, but it just it's not that common, to be honest with you.
Yeah, that makes sense. Anyone else have questions? You can also feel free to raise your hand because I can allow you to talk if you do that. Jordan, anything like really common questions that come up in the alt protein context, say maybe like a cultivated meat company, some unique challenges that they might face in this process?
I think that it's really the challenges are around, for starters, there's a long time horizon in this industry, right, to commercialization. So kind of understanding the capitalization is really key here. This is not like a standard consumer product, consumer product group where they're going to be generating revenue and be in stores, next year, and the projections, bear that out, and we could see that. So a lot of times we're trying to understand what the long-term capitalization liquidity plans look like. And then also, what we hit on a lot, and I think what a lot of the questions are about, which is a lot of these assets are relatively new. This technology and these processes are relatively new and can be, specialized and have proprietary components to them. So just understanding the equipment itself and its inherent value, I think those are kind of the two main challenges in this space. But again, that's something that we do all the time, in life sciences and biotech and other, kind of clean tech and related verticals. So it's a challenge, but it's also comes with the territory of lending in this early stage space.
Great. I'm tapped out on questions and don't see any more in the Q&A. So is there anything that you would like to leave the group with?
Yeah, no, I appreciate everyone's time and interest. In terms of transaction sizes that CSC will look at, we can support on equipment projects that maybe start around $100,000 and go up to as high as 20 million. New and used, as I mentioned before, and vendor and asset agnostic. So all in all, if someone wants to talk about a specific instance or kind of use case, or if they want to just ask about their potential eligibility and what a structure might look like, I'm happy to kind of turn around some indicative pricing after we have a phone call and look at some information over the course of a couple of days. So feel free to give me a call offline, anyone, if you want to chat about that.
Great. Well, thank you, Jordan. I learned a ton. This was really great content, and appreciate your leadership and commitment to the alt protein space. I think you're a little early to the party here with us, so that's really great. All right, everyone, feel free to get in contact with Jordan or let me know if you have any questions. I posted the link to sign up for next month's webinar on overcoming gender bias in this industry, so I think that should be a good one as well. And yeah, I hope you all just have a fantastically productive month.